Welcome back, and joining us for a look at the equity space is Antonio Senatore from Cartesian Capital. Thank you so much for your time, Antonio. Quite interesting moves that we're seeing in the markets today. I would have expected a sea of red on the JSE and the rand under pressure with the NHI being signed into law. But we're actually seeing even counters that were under pressure for the past few days, like Discovery now today up. The JSE displaying a gain there, and also the rand inching closer to that 18 rand level against the US dollar. Are they just shrugging off everything that's happened locally and maybe holding on to US CPI?
Yeah, so US CPI I think is the main driver. I don't think the rand is too phased with the NHI bill. It's a very liquid currency. It's easy to get out if need be. And the NHI is going to take a long time to implement. So the announcement of the NHI bill being signed into law obviously impacted a few stocks. For example, Discovery, that fell more than 8% yesterday. Netcare was down more than 3.5%. But today, Discovery is up 4%, Netcare is up 2%. At first, I thought maybe Cyril lost his pen. But I think that the market is probably just thinking it's an overreaction, that the NHI bill will take some time, as I said, and it's no doubt going to be challenged in the courts. And obviously, there's a bit of uncertainty in the space, so we can expect volatility in those insurance stocks. But CPI, as I said, was the big one. Both, I think the markets and the Fed had been hoping for positive news on inflation, especially after 3 disappointing CPI reports earlier this year, which raised the question whether the Fed would hike rates again. But Powell yesterday assured us that they're unlikely to hike rates again. And today's print probably reinforced that. So we did see markets rally. And I think the Fed does want to cut, but the data just hasn't really been cooperating until now. But inflation is still elevated. I think it is still sticky, so I don't think we'll see a cut at the next meeting. And one more thing I want to say, if you look at what the market is pricing in, yesterday there was a 65% probability that the Fed would ease rates in the September meeting. But after today's print, that probability has now increased to almost 73%. So the market is pricing in. They've got more conviction of a rate cut in the September meeting.
Well, Antonio, just circling back to the impact of the NHI, because as you mentioned yesterday, Discovery was down sharply 8%, but today it's up more than 4%. I'm just wondering, with these market moves that we're seeing, and it's been quite a lot of pressure for the past few months, do you not think that the markets have been overreacting, particularly on the point that you made, that even if it does get to a point of finalization, it's going to take a while for it to actually filter through to the ground? Or is it just a story of investor sentiment and confidence at this point?
Discovery hasn't performed well, since the beginning of the year, whereas the JSE is in the green. So it might be an overreaction. We might see some buying, but we will see volatility. I think we will see volatility in those stocks, the insurance stocks, because they could lose their healthcare funds on the hospital side because the NHI tariffs will affect them. So I do think we'll see volatility in the space.
All right. Well, let's take a look at some of the company news that came out of the JSE. Napier Rockcastle did come out with a business update today for the first quarter of FY24, really looking at growth in their key financial metrics. Napier Rockcastle is seen as, well, actually, I'm asking from you, would you see it as a defensive property stock considering its exposure to the regions that it is exposed to?
Yeah, so they operate in Central and Eastern Europe, and I do think they showed very robust performance. They are in the retail space, so net operating income increased 12.7%, tenant sales have surged 10%, foot traffic up 2.1%, which indicates quite a healthy retail environment in those regions, which is a continuation of the return to retail malls, where post-COVID, people are going out and socializing. So I think it is defensive in a sense. And that trend has continued. They're getting more people into the stores, and people are spending more in those stores, which has been positive for them. Also, something I saw is their loan to value ratio is at 31.5%, which is at a very comfortable level. Some of our local REITs are closer to 40%. And they also maintain a very strong liquidity position of 1.4 billion euros in cash, and their development pipeline remains robust. So I think they're well positioned for continued growth.
Yeah. Well, something that isn't growing, Santova, they came out with their year-end results, everything there in decline, headline earnings per share, revenue, it goes on, the list goes on. What do you make of how Santova is performing now, considering also that there was quite a lot of optimism on the company last year?
Well, it definitely hasn't been an easy year for Santova. Revenue down 4.5%, headline earnings per share down 20%, and they didn't even declare a dividend because they want to reinvest that cash into the business. And this was all because of a drop in shipping rates on the back of lower consumer demand and also increased overhead costs from high inflation. But they did somewhat mitigate the impact on trade volumes and profit margins because they did acquire additional clients over the period. I think the optimism came from the fact that ships had to reroute around Africa instead of the Suez Canal, which has led to an increase in container rates, which has also somewhat reduced the impact.
All right. Well, Antonio, we do have to wrap up the conversation, so let us get to your stock pick for today.
Because I've chosen Combined Motor Holdings. It's a small cap stock, a market cap of around 2 billion rand, and it may perhaps be ignored by the market and certainly by institutional investors because tradability is low. But it recently released results which showed a consumer under pressure, and they discounted new vehicle sales because they had excessive stock, which has been a negative impact on margins. But the company trades in many of the well-known vehicle brands. It's well represented in the value segment. And it also has a car rental business, First Car Rental. I'm sure you've heard of that, which should continue to benefit from increased tourism and business travel. The segment has become more competitive, but its margins are higher than the vehicle sales segment. And importantly, it has an alliance with FlySafair Air, which has been very beneficial to them. They've also got a strong balance sheet. Cash resources were up by 7% to over 800 million rand. But looking forward, I think the oversupply of vehicles should lessen, which would allow them to do away with those excessive discounts that they're currently employing. And lastly, I think the counter is also attractive
Recording stopped.
in that its dividend yield is around 14% and a PE of around 5 times, which is not demanding.
All right. Well, thank you so much for your time and for your insights on what has moved investors' money today. Antonio, appreciate the time. That was Antonio Senatore from Cartesian Capital.